All right, everyone. Hey, just want to thank you for coming out today, and we're just going to talk about, of course, how you can go out and help some of those commercial clients. And today I have on my underwriting specialist Jesse Hagan, and we're going to talk, of course, commercial today. And let's, I know Jesse has put together a great presentation for us. We're going to, of course, since today is our first day, really kind of getting into it. We had some technical difficulties in the past, but with that being said, have gotten that resolved, and so now we're going to be off and running with this, and we're going to be on every month, anywhere between 30 minutes to an hour, depending on the questions that you guys have. And so, of course, in today's market, we just want to make sure that our realtor partners have multiple ways of going out and being productive, and we feel that commercial is going to be another avenue for us to be able to go out and take advantage of it. So with that being said, my friend Jesse Hagan, she's going to take it away from here.
Thank you very much, Wendell, and thanks for having me on. Specifically, we're going to talk about SBA lending because that's my expertise. And so I put together this presentation, which I am going to share with everybody, and we're going to kind of go through it. And let's do this. Got to do it here. Anyway, first of all, we're going to talk about the 7A loan program because the 7A loan program is the flagship program of the SBA. It is where banks lend their own money and the SBA guarantees a portion of it. Usually it's 75%, but there are situations where the SBA will guarantee more than that. Let's say it's a company that is involved in exporting. They have an international loan program. The maximum loan amount is $5 million, but frankly, there are banks that will go over and above that with a conventional loan. Those are usually credits that are very strong. They are usually real estate based. But the issue is that the SBA says, one borrower or related borrowers and affiliated businesses, for example, can obtain more than one loan, but it is limited to $3,750,000 of guaranteed portion. So we could do $1 million loan, $1 million loans, and a bank can go over that. And if they do that, their options are to either decrease the amount of the guarantee on the last loan that they make so that they don't exceed that 3.75000, or they could make a conventional loan on top of that. Again, those are for really strong credits, and it's a bank-to-bank kind of decision. You don't see it very often. The SBA program is designed as an incentive for banks to make more loans to small businesses. It obviously reduces the bank's risk, but it also provides long-term commitments. And the benefits are different for every sort of scenario. Usually, it's the lower down payment. With an SBA loan, you don't have to put 20% down. There's not a loan to value that a bank has to back into, for example. And by the way, if somebody does have a question during the this presentation, please feel free to raise your hand, do whatever you need to get Wendell's attention, and I'll stop and certainly answer any questions. Otherwise, I'm going to move kind of quickly through this because these are the basics, if you will. Going back here to the down payment requirements, there are also no balloons. And SBA loans are frequently not fully collateralized. That's the primary reason a bank would choose to use an SBA loan. There are some minimum equity or down payment requirements in certain situations. SBA established 10% of the project as required for any startup business or a business purchase, or what they call a change of ownership. So it's 10% of the project. Project means the purchase price of the business, any working capital costs that are also going to be part of the transaction, closing costs, SBA fee, etc. Those are all lumped together into one number, and then the 10% is calculated from there. There are multiple ways to get to that 10%, especially in the case of business purchases, and we'll cover that a little bit later. Again, banks can always require more than just that 10%. SBA does not have a minimum equity requirement for established businesses when they are purchasing a building for their use or buying equipment. The business must demonstrate that it can repay that larger debt based upon the most recent year end and the year-to-date financial statement. The bank's going to look at the balance sheet of that company to make that decision if they're comfortable enough doing that. And usually what they're hoping for is that the company's got, positive net worth and has shown that they've had historical profitability and reinvested those profits into the business. Now, borrowers can be a business, a real estate holding company, or individuals, but there always has to be a business, and it's that company that we are looking to for repayment ability. So in other words, if a building is being acquired and is owned by Joanne and Jim Smith, they can lease that building to their company, and we're looking at that company for its repayment ability. These are SBA loans, which are small business loans. They're not investor loans. One of the unique things about SBA loans that people don't know a whole lot about, but really come in handy, is that they do not have financial covenants. They have restrictions, but they don't have tested requirements like conventional loans often do. And what people don't realize is that you trip a covenant, if you don't meet that requirement year after year, a bank can use that as a tool to ask you to leave or not refinance their debt. And again, SBA loans, they don't have balloons. If we offer you a 10-year note, it's a 10-year amortization. They always match.
So hey, Jesse.
Yes.
So can you explain what a financial covenant would be? Just an example of it.
Sure. A very common one would be that a company has to test quarterly, would be a minimum debt service coverage ratio. And let's say, a bank says it has to be a minimum of 1.25 times each quarter based upon a rolling, 12 months. So that would be very commonplace. Sometimes they have a minimum net worth covenant. There's usually 3 or 4 of them, depending upon the situation.
Okay. And then another quick question for you.
Sure.
So I guess, can you explain the difference between the max loan of $5 million and the $3.75 million?
So 3.75 is 75% of $5 million. So that's the guaranteed portion. So the way the SBA regulations read is that the maximum SBA loan is generally $5 million, and maximum amount of guarantee, except for those exporters, is $3,750,000. So, again, we can make multiple loans to the same borrower, and I've done that many times. So I make one loan, as I said, for $1 million. A couple years later, I make another loan for a couple $1 million, etc. Eventually, I might get to the point where I cap out, and all of a sudden, I'm in a situation where the borrower's needs exceed $5 million. So I could still lend additional money to them, but one option is I'm limited so that all of their guaranteed portions, when all added together, they would only cap out at $3,750,000. And yet, let's say I make some additional loans and we now have outstanding to one borrower $6 million. All the loans might have been 75% guaranteed, but that last loan that I make that takes it over that $5 million mark means I might have to reduce my guaranteed portion to 60%, just so that it doesn't exceed that $3,750,000. Does that make sense?
Yeah. So when you reduce it to 60%, that means you reduced it by additional 15%, and then so you're taking that 15% and adding it to the new loan. So I guess that
it's not that I'm adding it to the new loan. My point is, I'm using, again, illustrating without showing any pictures here. Let's just assume that all of a sudden the last request is for $2 million and we're already got out $4 million to somebody. I would have to do a calculation. Maybe it comes to, 62.2%. It's just they still get all the money that they're looking for, but the bank guaranteed portion, instead of normally being 75%, it is reduced. And it might, the calculation again could be, 37% of my loan is guaranteed or 50% of my loan is guaranteed. I don't know. I'd have to back into how much guarantee I'd have. And it's a bank-to-bank decision to say, this is a good established borrower with us. We have history with them. We like them. We think they're doing well. And we're okay giving them another SBA loan, but because they've maxed out their guarantee, we're going to be unsecured or under guaranteed on a portion of it. Is that making sense yet?
Yep.
Okay. And again, these are kind of the concepts that, 1 in 15 conversations, it comes up, probably less than that, 1 in 25. But the point is to kind of put an asterisk out there that, yes, $5 million is the maximum loan amount. And generally that means the SBA is guaranteeing $3,750,000. But there are some exceptions that banks can make. So it's not as black and white as it might seem, is the point. All right, so repayment period. Usually, if somebody's buying real estate black and white, you've got a 25-year note, 25-year amortization. If someone is buying a business, there is no real estate as part of that sale, then we're going to give them a 10-year loan, 10-year amortization. If someone's buying a business that does include real estate, we usually then would end up with a blended amortization. Maybe it's 15 years, maybe it's 14 years, depending upon, it's a weighted average. If the real estate makes up more than 51% of the total project, then we can still do a 25-year loan. But most commonly, and what I want people to walk away with is, most uses of funds fall into 10 years or 25 years. I want to just make sure I didn't hit upon anything else. All right, let's talk about who is eligible for an SBA loan. In determining what constitutes a small business, the definitions do vary, and there's multiple tests that we can run. But most of the time when we're talking to a privately owned company, they are going to fit within these realms. 500 employees is the maximum number of employees for a manufacturer, and that's a really big manufacturing company. Wholesalers can't have more than 100 employees. And then if they're in the retail sector or a service business, then we go to a revenue size standard, and they range all over the board. Auto dealerships, for example, are eligible, and their number is probably in that $30 million a year range. And the SBA periodically modifies these. But there's also what we call an alternative size standard, where we look to an applicant and their affiliated companies. And again, I think affiliated, easiest definition for most people, they are related by common ownership and generally in the same industry. In those cases, when combined, they cannot have a net worth. Let's see here. An applicant business must have a net worth, below 15 million. I was gonna say, the way it was worded didn't seem right. Below 15 million, and in the past 2 years of after-tax net income, it must average to be less than $5 million. That covers a whole lot of companies. I'm not going to go into this affiliation because it has changed and gotten simplified, but generally speaking, a business in the same NAICS code as the applicant business, let's say a restaurant and another restaurant, and if it's owned more than 50% by the same person or company, with more than 50% owner of the applicant company, they're an affiliate. A business owned by a majority guarantor that is unrelated and in a different industry is not an affiliate. And this definition just changed last year. Again, it doesn't come up very often, but every now and then you run into people who do have a lot of, their hands in a lot of different businesses, and then we have to really do some digging. SBA is looking for for-profit businesses. Nonprofits are not eligible for SBA. They have to make their primary operation in the United States. And the other language here, make a significant contribution to the U.S. economy through payment of taxes or use of American products, materials, or labor. Just straight out of the regulation book.
Right.
They're looking at companies that are independently owned and operated, not dominant in its field, which again, I've never run into a situation where we've said anybody's ever been dominant. But they could be an LLC, a sole prop, partnership, incorporation, and even ESOPs and co-ops are SBA eligible borrowers.
What's an ESOP?
Employee stock ownership program, which are becoming much, much more common. And unique thing is that SBA will finance the actual sale of a company to the employees. Again, it's not done very often, but the SBA is encouraging it and has rewritten the rules recently to try to make it a bigger part of all lenders. And so it's an education ploy at this point in time in terms of getting the word out that SBA can use for that.
Okay. And so I guess what we'll do is we'll cover the rest of this down to the laundromats, and then we can cover, what types of businesses are not eligible, on our next session, just in case Loretta and Aruna have any questions.
Absolutely. I mentioned this a little bit before. Okay, wait. First, let's go back to the other one. At least 51% of the ownership must be by U.S. citizens or individuals who hold a lawful permanent residence card. So a green card, they are eligible. If the loan request is to buy real estate, this is what I mentioned before. For a business to occupy, the business must, I'm so sorry, I'm making a mistake here. This is a different issue. If the business is going to be buying real estate, the operating company must occupy at least 51% of a building. Rent income from tenants is not included in the cash flow analysis. So this is an important concept, especially for realtors. It is the business cash flow that's going to be analyzed, not what they're paying for rent. And ownership of the real estate, again, can be in a real estate holding company, but the lease payments are limited to an amount equal to the principal and interest payments, plus enough to cover insurance and real estate taxes. So in other words, the borrowing entity or the operating entity, we are analyzing them and they will be making a lease payment to the holding company, but the SBA says the amount that they pay to that real estate holding company is limited to an amount that's equal to the P&I payment plus an estimated amount for the insurance and taxes. So a written lease is always required in those cases. Lastly, laundromats, self-storage facilities, campgrounds, and RV parks are SBA eligible as long as less than 50% of the revenue is derived from transients who stay for 30 days or less. In other words, RV parks, a lot of people who own an RV park, what they're really looking for is people who are renting one site year round. And if they have more than 51% of their revenues derived from those long-term rentals, they would not be SBA eligible. Okay. Now, self-storage facilities and laundromats, the transient comment doesn't apply to them. I mean, a laundromat always is going to be eligible. Self-storage facilities, they're renting to people that could be month by month, could be yearly, and those also are always eligible. It's really just the campgrounds and the RV parks that we're talking about, the transient population.
Okay.
And transient, of course, just means, day to day, week to week versus, annual. So, yeah. Right. So I know I've gone fast and I made some errors in the way I've delivered this, so I apologize. But
I think it was great. I mean, just to kind of kickstart off, what we're trying to do, I think we're really going to, be able to help a lot of my realtor partners out there in the market and, let them start looking at things differently versus just looking at residential. I think they can kind of start looking at, commercial and possibly, finding transactions that'll fit into, of course, the SBA parameters. And we can come on this forum and talk about that. And you know, and that's really what I want to do is just kind of help my realtor partners really grow their production. So I think that was good. You know, yeah, I mean, it's a lot in there. That's why I said, well, hey, look, you know, we'll cover more, you know, during the next session. But hey, you know, Luetta and Aruna, if you guys have any questions or anything like that, you know, please ask Jessie while I have the expert on the line. I mean, she's very busy. She's, you know, every time I call her, she's like, hey, you know, I have to schedule an appointment with her to kind of, you know, get on her calendar to talk about some deals. So hey, now's the time while I have her attention. But if not, you know, you guys can email me and I'll reach out to Jessie and get those questions answered. Okay. All right.
No, this was very informative. Thank you so much. Since I come from a commercial world, I've explored the different kinds of financing, but this was definitely a layer on top and a good refresher for me.
Good. Glad you thought so.
Yes, ma'am.
Yeah, just make sure you come back from now on, Ms. Lewis, because I want to make sure that we can, and then of course see if your team want to join as well, so that we can kind of get them, you know, well versed and educated as well.
Absolutely.
Right. And I should mention, you know, I have a whole presentation specifically dedicated to changes of business ownership, which you might be involved in. You know, restaurants, of course, come your way. Probably nobody goes looking for them; they find you, right? But you know, everything from daycare to manufacturing to other retailers, the SBA program is frequently financing those kinds of transfers, and lots of information. Those rules change every couple of years, and they've changed quite a bit again in this year. So we'll be having one of those presentations soon.
Yeah, I would love to hear about that. I actually have clients that are in a lease purchase on a restaurant, and once I've spoken to Window about it, once we're at that 2-year mark, we're going to be looking for them to transition out of the lease into financing. So absolutely, we'll be in touch.
Sounds great. All right. Well, thank you for joining us. Aruna, anything that you wanted to ask?
No, I just wanted to say I am definitely interested. I would, definitely join the next session because, I want to learn, even though I'm not in the commercial, but I definitely want, it's something that is on my mind.
Okay. Very good. Very good.
All right. Well, thanks so much, Jessie. Thanks, guys, for coming. And Jessie, I will talk to you later.
All right. Sounds good. Have a great rest of your day, everyone.
Thanks. You too.